earlier you plan, the more you can save. The number one negotiating strength that a seller has is that the business continues to perform well. Negotiation is a game of stamina and persistence. If the business is faltering and you look exhausted and tired, the buyer knows that you don't have a lot of alternatives. I think your biggest enemy in negotiation is emotions. I think a lot of founders view the sale of their business almost like a one-time project. It's a one-time event. So when they get ready to sell their business, they come to us and say, I'm ready to sell my business now. I hit my EBITDA number. I hit my revenue number. I think I'm at my valuation. I'm ready to sell my business now. Can you help me sell the business? Mm-hmm. And of course, we'll say, yes, we can. But the reality is, most business owners have never sold a business, and selling a business is kind of like preparing for a marathon. To run a successful marathon, to complete it, but also have a great result, you have to prepare. You have to prepare and train like you would for a marathon. And I would say, ideally, that preparation time is 18 to 24 months. And if you spend the time and effort to prepare adequately, you will have a significant ROI and a much better outcome coming out of that experience. So my number one advice is prepare in advance. It will pay so many dividends. First of all, what's value? What's value to a business owner? Value is typically EBITDA times a multiple. And don't forget, it's minus taxes. It's EBITDA times multiple minus taxes. And so I think where people oftentimes are focused so much on the multiple. When someone looks to hire us, they say, what kind of multiple can you get for us? I think I want an 8 times multiple. And therein lies the oversight where, one, they don't maximize the EBITDA. 2, they don't plan for taxes. And I think that's an area that we always kind of bring attention to our clients. So first of all, every private equity firm, when they sell their business, they're going to do a quality of earnings. The private equity owned company has a great accounting team, great CFO. Sometimes they're audited. They're certainly following GAAP accounting. But even then, when they get ready to sell, they are going to do a quality of earnings on their own company. Why? Because EBITDA is not a GAAP metric. It's about how do I fully load all the adjustments so that I can market the maximized EBITDA. And private equity does that. Business owners should do that. And they should do a seller's quality of earnings. Don't rely on the buyer, because buyer's not going to maximize your EBITDA. Buyer's focused on doing diligence and maybe even like cutting down your EBITDA. So you have to do a seller's quality of earnings. If you don't do a seller's quality of earnings, you don't know what your fully loaded, maximized, adjusted EBITDA is. And I would say that's the equivalent of selling your home without knowing the actual square footage. If you actually measure your home, you might find that, hey, there's actually like the prior measurements were wrong, or there's actually some hidden space here. And that's how you maximize value. That's the first point. So do a seller's quality of earnings to maximize your EBITDA. Now, the second part is the multiple. And the last part, as I mentioned, was planning for taxes. When you sell your business, you're going to pay 20% on capital gains for the federal level. If you live in the glorious state of California, you're going to pay another 11, 13%. So almost a third of your sale proceeds goes out in taxes. So you effectively have a third business partner that you have to pay, and planning for that in advance can help you sometimes eliminate all of that. So, and that would be the equivalent of getting two, three times more on your valuation multiple. So a lot of people don't plan for taxes. There's a lot you can do. And the thing about taxes, it goes back to my first point, is the earlier you plan, the more you can save. And if you come in and say, I'm going to sell my business in 6 months, very little you can do. After you get an LOI, almost nothing you can do. So advanced planning can save you millions, millions in taxes. The simple rule to M&A or exit planning is do what private equity does. Private equity is certainly in the business of buying companies, but every company that private equity buys, they know they're going to sell. So in terms of the experts in preparing a company for a sale and executing that sale, private equity has figured it out. They have the gold standard. So do what private equity does, and that's kind of like the first step towards mitigating a lot of these pitfalls. And from a business owner's perspective, chances are you've never sold a business before. So how do you emulate what private equity does when you've never done it before? Well, and that's where the team comes in place. I think for a successful M&A transaction, you have to surround yourself with an all-star team, and that all-star team is going to drive home a blockbuster outcome. And so what does this team consist of? I think, first of all, you want an exit-oriented CFO or fractional CFO. A lot of middle market CFOs, they can help you run the business, do good accounting, but selling a business, as I kind of described, that's a different sport. And you want someone that's exit oriented. And frankly, you'll sometimes see private equity bring in a new CFO 2 years before they prepare for an exit because they want a different CFO for growth and a different CFO for exit planning. So CFO, fractional CFO that can help you prepare for an exit, essential. Second, start talking to an M&A advisor. M&A advisors are always more than willing to give free advice, and they can kind of help you drive towards a path that would maximize the certainty of the outcome, but also the value of the outcome. As I mentioned, talk to a tax advisor. And again, this is not the CPA that does your annual tax filings. That person's job is 99% filing taxes. There's a special breed of tax advisors that focus on exit planning. So I would bring in a tax advisor. And lastly, I would bring in a wealth manager. The M&A advisor can help you make a lot of money and get rich, but the second half of the game is wealth preservation. And that's where we encourage every one of our clients to start building a relationship with a wealth manager so that they're set up to mitigate taxes and preserve that wealth going forward. So build the team that has specialized experience around exit planning. That's the first path to avoiding these pitfalls. Value to a founder is EBITDA times multiple minus taxes. And we see this often because we do a lot of buy side work as well, we see leakage across all of those. First of all, a lot of times business owners, they don't do a seller's quality of earnings. That means they're not marketing their fully loaded EBITDA. And so someone might say, well, I have a 600,000 or I have a 1 million, 2 million EBITDA business. And then we go in and do the quality of earnings. There's actually more EBITDA. We recently sold a business that was 1 million. The owner thought he had 1 million EBITDA, and we came back and said there's actually 1.7. Thank goodness we were on the sell side, so we helped him market a 1.7 million EBITDA business. But if we were on the buy side, he could have gotten a really good multiple on 1 million EBITDA, and the buyer would have known that there's actually another 500,000 sitting there just for their picking. So number one, sellers don't do their own quality of earnings, and they end up marketing a lower EBITDA without even knowing it. The second one is they sell at a low multiple. I think sellers try to do their homework and they go around asking, well, I'm at this stage, I'm in this industry, I have 3 million EBITDA. Like, what's my value? And whether it's an investment banker or a lawyer or a friend, colleague, they'll say, oh yeah, that should be, 7 to 8 times, or that should be a 10 times multiple. The reality is when people quote multiples in generality, it's usually more of like an average or a median. Now you see, big public companies trading in the market, but when they get sold, someone will pay a 30% premium on top of the prevailing stock price. So there is such a thing as an M&A premium. And when someone is just comfortable with that average multiple quoted in the market, they're not really maximizing their valuation. And so time and again, we see that when a very competitive process is run and the seller is able to find the best fit buyer, a buyer that appreciates what they've built, the geography, their customer base, their technology, and so forth, that buyer is willing to pay a premium. And that's where they get an outsized multiple. So a lot of times they don't have an advisor. They just take someone that's willing to offer that median average multiple. And that's where there's a lot of leakage as well. And lastly, I'll go back to my point about taxes. Very few sellers prepare for taxes in advance of an exit. Um, and I think that's because they don't engage any advisors until they're ready to sell. And at that point, there's not much they can do. And I think qualified small business stock is a case in point. So if any client comes to us and says they're looking to sell in 3 to 5 years, we always suggest that they consider Section 1202 qualified small business stock, because that means they could save on 10 million or more in their capital gains taxes. It's a huge needle mover. It means that the seller is going to keep millions more in their pocket when the transaction is done. So again, there's leakage across all fronts when we look at sellers exiting their business. Oftentimes, especially when the buy side, we say, okay, we're interested in acquiring a company. Can you share your financials? And they will just export the financials from their QuickBooks or Xero, whatever platform they're using, and they'll share those financials with the buyer. And now I like to call that the here's my data, you figure it out strategy. And as I always like to say, facts tell, stories sell. And that goes the same with your financials. You don't want to just give them the facts and let them figure it out, because trust me, if the buyer's figuring it out, they're not going to be as bullish about your financials as you are. So you have to sell the story behind the numbers. And when I see a founder or a business owner that just provides the financials and assumes the buyer's going to figure it out, I almost know 100% that they are going to undervalue their business, because they're waiting for the buyer to tell them what the value of their business is based on those facts. So that's like a number one red flag in my mind. When we talk about negotiations in the deal, sellers or business owners often think about like, oh, how am I going to negotiate this clause better? And if there's like something about the escrow or holdback, oh, what should I ask for? Oh, I should ask about the escrow instead of a holdback, minimize the dollar amount, minimize the term. And they think very tactically. But and that's all very important. That's something that everyone should do. It's straightforward. But if I take a step back, the number one negotiating strength that a seller has is that the business continues to perform well. If the business continues to hit it out of the park, every buyer wants to buy that company. When every buyer wants to buy that company, that's when they're able to get a better structure, get a higher multiple, get more concessions on deal terms, and so forth. So we always emphasize the way a successful M&A process works is the M&A advisor focuses on everything M&A. The business owner continues to focus on running the business very well. If anything, this is a final sprint, and they should run the business like they've never run it before and make a sprint to deliver the best results for the next 6 months. Because if they do that, that gives the M&A advisor the ammunition to be able to negotiate very strongly across every front. What we often see, the big mistake is where the owner ends up doing a lot of the M&A work. They have to, crunch the numbers, clean up the numbers, prepare some of the materials. They have to like talk to all the buyers, and they get distracted from running the business. And before you know it, revenue growth slows down. They might lose a customer. They might have missed some important price increase or something like that. And a hiccup happens during the 6, 7 month sale process, and that gives the buyer an excuse to say, "Oh, wait a minute, you just lost a big customer, so I don't know if I can pay the same value." And that's where they lose ground. And also, if the business owner is involved too much on the nitty-gritty of the M&A, you know, they get exhausted. They get tired, fatigued, exhausted. And when you're exhausted, you're not going to be able to negotiate strong. Negotiation is a game of stamina and persistence. So the number one strategy is you divide it up so that the owners continue to execute on the business, so that the M&A advisors can focus on the M&A. And lastly, we would say your negotiation strength is as strong as your BATNA. Your BATNA is basically your next best alternative in a negotiating position. If your business is running really well, and the buyer tries to retrade or is not being, giving you the terms that you need, you have a very strong alternative. That's to walk away. Your business is performing well. It's doing better than ever. So you can walk away and you'll have plenty of alternatives, whether it's to continue to run the business or to sell to another buyer. And when the business is running well, the buyer knows that. They know that you have alternatives. And conversely, if the business is faltering and you look exhausted and tired, the buyer knows that you don't have a lot of alternatives. And that's where you lose your negotiating power. So, the strength of negotiation kind of comes from that unintuitive area where actually the seller should not be the person negotiating. The seller should be the person running the business in an incredible fashion. That's one of the reasons as we started building this firm that we decided to try and change our business model to be hourly billing as opposed to a success fee. Because what I found is for an owner operated middle market business to have a successful exit, it has to be a very high touch exercise. Because again, I want the business owner to focus on running the business and the M&A team to do everything from cleaning up the numbers, running the analysis, building the forecast, doing the quality of earnings, preparing the sim and all the exhibits, preparing the data room. Basically, don't add more burden to the business owner. Actually, help the business owner focus on execution so they can deliver some of the best quarters that they've ever had, because that's what drives a very successful outcome. And I think, the way our team is set up, we have our own quality of earnings team. We have our CFO services team that can help company get ready for an exit. And we have the M&A corporate development team that can help run the M&A process from soup to nuts. So we had one business owner, as we were getting close to the signing of the purchase agreement, he was actually vacationing in Hawaii. And that's not because he didn't care about the outcome. It's a testament to how much we're able to take off the business owner's plate, and they were able to kind of run business as usual, do very well, and also take vacation when they needed to. So this person was not exhausted. They had plenty of alternatives, and they got a phenomenal deal. And I think that's how we really help companies successfully navigate and negotiate a great outcome when they go down the path of an exit. I think your biggest enemy in negotiation is emotions. The person that wins negotiations is the cold-hearted killer, that's going to look at everything objectively and not be burdened by pride, ego, or emotions. And what I find is when a business owner is selling their business they've grown for 5, 10, 20, maybe 20 plus years, it's an emotional endeavor. It's a very emotional endeavor. And that person can't be at the forefront of negotiations. When we run a process, we don't let the buyers directly engage with the sellers. There might certainly the management presentation, they'll directly engage. There might be some principal points, but when it comes to contentious negotiations, we don't let the principal seller directly engage with the buyer because you lose on two fronts. One, the seller is not a trained negotiator and it's their baby, so they can get emotional, understandably. So you're already kind of going in handicapped. And the second thing is the seller is the final decision maker. And one of the key moves in negotiation is to say, I hear what you're saying. Let me take that back to my client. And that A buys you time and B gives you flexibility to maneuver on that point. But if you're the final decision maker, you can't do that. So for those reasons, I think the biggest enemy is the seller directly trying to negotiate all these things. Um, and a great M&A advisor would kind of separate the owner from those. And also, I half joke that a great M&A advisor is a part-time therapist. Because after every call or every interaction, you got to check in with your client to see how they're feeling, how they're doing, and help them get through this emotional journey. That can be a real whirlwind for 6, 7, 8 months. And being there for your client and helping them regulate their emotion is another key part to a successful exit path. We've had a lot of clients that would get understandably very frustrated during negotiations. Um, and it's really, I think, up to the M&A advisors to help guide them through that path so that they can look at it like a stone cold killer, and make the right decisions, make the right rational decisions in the most difficult times. The vision behind Embarc was to bring the level of advisory that Goldman Sachs, McKinsey, and those folks deliver to the Fortune 500. We want to kind of port that over to the middle market, really deliver the best in class M&A advisory. Early on, I quickly realized that middle market firms, these deals are very different from a big Fortune 500 deal, because when we're doing a Fortune 500 deal, Goldman might be the M&A banker, McKinsey might be the consultants there, KPMG might be doing the accounting, the quality of earnings, and tax preparation. You have some ridiculous law firm like Wachtell or Cravath supporting the M&A. This is a stacked team. This is better than the all-star team. But in the middle market environment, they often don't have access to all of those advisors and the expertise they need in every faucet. So I think we do two things that really deliver a different experience and outcome for our clients in the middle market when it comes to M&A. One, we provide very comprehensive services. We're not an investment bank. We're not a broker. We are a full service corporate finance advisory firm that specializes in M&A. What does that mean? That means we have a strategic finance team that can go in, support the management team. If they have a CFO, support the CFO to help get the business ready for an exit, to maximize value and optimize performance. That's number one. B, we have a quality of earnings team that's led by a former Big Four consultant that does that quality of earnings analysis to identify all the add backs and maximize the adjusted EBITDA that we can credibly market to buyers. And more importantly, when buyers diligence it, we can effectively defend those. So we have a quality of earnings team in-house as well. And thirdly, we have our M&A and corp dev team, which is former private equity guys, former corp dev guys. So they've certainly been on the sell side, but they've also been on the buy side. So they know how buyers look at this, which I think is a very differentiated quality for our senior team. So you get this full end-to-end team that covers all aspects of the transaction. And if there's any external, specialties that we need to say around tax or wealth planning, we'll bring in those advisors, and we work with, I think, some of the best in the industry. Um, and I think that kind of comprehensive team approach really helps differentiate the outcome for our clients. So that's the first part, our comprehensive nature in terms of the service that we deliver. The second part comes in the form of a business model. I think traditionally, most middle market investment bankers, they charge a success fee. So if you close the deal, they get paid. And I think that model worked traditionally. But where I see again with the middle market is a successful middle market deal requires a lot more handholding and a lot more involvement than just finding the buyer and closing the deal to maximize the outcome. So we've changed it so that we bill hourly instead of taking a success fee. We don't take a success fee. Everything we do, we bill hourly. That means we can put in a CFO services team to help the company get ready, even if they're a year or 2 years out from an exit. So we can do that. We can do some additional work like the quality of earnings to help them get ready for an exit and maximize EBITDA. And most importantly, we can help them optimize taxes. So last year we closed a deal that was, let's say, $10 million. This person didn't even know what QSBS, qualified small business stock, is, never heard of Section 1202. He wanted to, sell his business for like $7 million. We ran a process. The top bidder was $10 million. So he's ecstatic. Now, what we did was we applied Section 1202, and he sold his business for $10 million and paid zero capital gains taxes. Now, if I got paid a success fee for this deal, whether it's a traditional $10 million asset deal where he pays a ton of taxes, or if it's a $10 million QSBS deal where he pays zero in taxes, the success fee is the same. There is zero incentive for the M&A advisor to spend, I think we spend another, say, 150 hours to make that Section 1202 happen. There's zero incentive to do that. And that's why we thought we strongly believe that an hourly model delivers a lot more to our clients. And the other thing is, let's say there's an earnout. Let's say there's a big deal and there's a big earnout. Now, a success fee model dictates that if there's an earnout, they get paid the success fee on the full value of the earnouts. But let's say 3, maybe 4 years later, they don't hit all the earnouts. Well, now the sellers paid the fee to the M&A advisor, but they didn't actually capitalize on the earnout. So there's almost this misaligned incentive where the M&A advisor is delivering a high multiple value for you, but a lot of it's in earnout or some kind of contingent payment that the seller might not see. And again, I think that's partially the reason where a lot of these earnouts don't get hit. In our case, I check in with our clients every time we sell a business, even years later, and I would say 90% of our clients or our clients have a 90% or higher attainment on earnouts because we're the CFO team. We help them build out the budget. We know this is a realistic, executable budget. So when they sell and they sign up for that earnout, it's not surprising that they actually hit those earnouts and they didn't pay any extra for that. The other thing is a lot of times business owners will roll equity. That means I might sell my business for $50 million, 10, 20 million of that I'm going to take in the buyer in stock. So I have equity in the new entity, and that equity might be worth a lot more in 3 to 5 years. Now, one thing that I find that most sellers don't do is they don't diligence the buyer's equity. So you might say, okay, I'm going to roll $10 million of my sale proceeds into rollover equity. Then the private equity guy says, okay, you're rolling $10 million. Well, I'll give you million shares then. It's $10 per share. How do you know it's $10 per share? Maybe it should be $8 per share. What was the last time the private equity priced their shares? And nobody diligences that because, again, from a traditional success fee model perspective, it's still a $50 million deal, 40 million cash and $10 million in equity, and there's no incentive to kind of get into this contentious argument and diligence the buyer's equity and say, oh, I don't think it's $10 per share. It should be $8 per share, and I should get 12.5 million shares. There's no incentive to do that. So for all those things, there are all these nitty-gritty things that if you had like stacked advisors, someone would cover. But when you really are relying on your one M&A advisor, they need to be able to cover all these things, your taxes, the value of a rolled equity, the attainability of our earnout, all of these things. And that's a lot of extra work. And the hourly model kind of sets us up to do all of that extra work. And by the way, when we get the whole deal done, it's still a fraction of the total fees that a typical M&A advisor charges. So that's, I think, the second differentiator that Embarc delivers to its clients. One is the comprehensive services that we deliver. And second is the way that we bill our services through an hourly model and don't do a success fee. This business owner came to us, and I'll just kind of use made up numbers. He said, "Hey, I kind of hit my target. I'm at 2 million EBITDA. I'd like to sell now. Can you sell this business?" Okay, we can sell this business. So first of all, we did a quality of earnings. Turns out he's really more like 2.6 million in EBITDA. So we told him, hey, you're not 2 million EBITDA. You actually have a lot more. This is a 30-year-old business. Over the course of 30 years, the way the owner operated the business, there was a lot of things that really would not carry forward when the business sells. So when you kind of identify all of that, not just the owner's salary and basic things like that, but all these little things, 10,000 here, 20,000 here, 50,000 here, they add up. So now we're able to market a much higher EBITDA. So that's great. He had private equity knocking on his door saying that they would purchase his business for 7x multiple. It was kind of like an average multiple for the industry's in. And he said that's what he's targeting. He wants 7x on his 2 million EBITDA, now 2.5 million, 2.6 million EBITDA. Now we launch and we market the deal. Within the first week, one of the buyers that took the sim said, hey, I'll pay 9x, take this off the market. And so our seller is astounded, like, oh, this is fantastic. It's way more than what he expected. But what do? We bill hourly, so we're incentivized to do more work. So over the course of 48 hours, because I think that the LOI was supposed to expire in 2 or 3 days, in the course of 48 hours, we called everyone that took an NDA and we said, hey, we got a preemptive bid. And I know this is a short timeline, but if there is interest, we'd like you to come in with an offer within 2 days. And 4 or 5 of those came in with an offer. But they would ask, okay, so what does it take? And then we give them a higher valuation guidance because we already have 9x in the bag. So we said it's going to have to be double digits. What's double digits? 10, 11, 12? And so long story short, we ended up getting this signed at over 12x. Great outcome. Now, fast forward, we're going through diligence, the quality of earnings checked out and keep going through. And then an issue came up and the buyer said, we can't pay over 12x. We're going to have to do this at, say 10.7. Now, our seller is livid. Like, I would never do business like this. This is a bait and switch. This was their plan all along. Their reason to retrade is totally unjustified. Like, I don't want to ever talk to these guys again. And, well, this is where you got to play therapist. Okay, I understand. Let's hold on. Let's think about this over the weekend. And then when we regrouped on Monday, I said, well, look, your initial goal was to sell this 2 million EBITDA business for, let's say, 7x. You were happy when you got it 9x. Even at 10.5x, this is way above what you ever expected. So we can negotiate this and make it better. But I think you should still engage with these folks and take this deal. And we kept pushing. He in the beginning was adamant that he doesn't do business with people like this. This is an integrity issue. He wouldn't leave his business and his employees with someone like this. And so, but we kept pushing. We kept pushing. And at some point, he asked, "Why are you pushing for this deal?" And that's when, like, thank goodness, I was so happy that we don't take a success fee, because if our compensation was contingent on the closing of a deal, I would have no grounds to say, I think you should take this deal because this is a good deal. It is not the deal that they initially signed, and it sucks when somebody renegotiates, retrades on the deal. But you have to understand, when the industry average multiple is 7 times, and you run a process where people stretch to the limit and bid over 12 times, there is no room for error. And so when this happens, this is when the buyer spent hundreds of thousands at this point. They don't want to lose this deal. There is no strategy where they try to do this and bait and switch. So it's a legitimate concern. And even if we took this back and marketed it again, sure, we would make more money. But would we get a significantly better deal? Questionable. Is it worth your time, effort, and angst and the emotional trauma that you go through from marketing it again? Probably not. And for those reasons, we think you should take this deal. And so, eventually we convinced him. We did negotiate the deal better, so it got significantly better than the initial counter. But that's like, I think this is a great case study. It's a recent deal because it kind of shows the value of the Q of E, the value of our role as an objective M&A advisor that's not, contingent on the close of a deal. And it shows that how we're able to kind of support in the most difficult decision-making processes and give unfettered objective advice, not to mention a great outcome for our clients. So, that's probably like one of the most memorable success stories that I have in the last, say, 12 months. A dollar lost is twice as painful as a dollar gained. So it's prospect theory and it's loss aversion. That's why when someone makes an investment and if it drops by 10%, they won't sell that stock because they don't want to realize that loss. And it's a bias. It's an inherent bias. And that's why, again, it's an emotional journey. And that's why you need an M&A advisor that is cold-hearted, looks at it objectively, and gives the right advice that 2, 3 years later, that client will look back and say, yeah, that was the right call. Maybe not even 2 or 3 years, like 6 months later, they'll look back and say, yeah, that was the right call. My advice to a founder is no matter how much you prepare, you are leaving something on the table. And it's not just $10,000, $100,000. It's most likely million plus. So the name of the game in a successful exit is preparation. Prepare, prepare, prepare. And even then, you won't be fully prepared, but you'll probably make millions more. So this is the crystallization of decades of work. It's not a 3-6 month project. The more you prepare, the higher certainty of close will be, the better your value will be, and the better your terms will be.